Now we gotta talk about similarities between the 2001 recession and today, and the uncanny warning that the 2001 recession gives to us today, and why you should probably paper hand a very specific part of your portfolio. Even though I am a licensed financial advisor, run an ETF, sell programs on Building Your Wealth, link down below, and run what I hope in the future will be a tens of multi-billion-dollar real estate startup, hashtag no guarantees, I cannot provide you personalized financial advice telling you to sell what you're about to hear a massive warning on. But what we're going to do is we're going to jump into BC Alpha's research on the recency bias and comparison to the 2021 cycle. I'll tell you, this is a very, very unique report. And so we're going to go through this report and then we'll summarize it. So ready for this? Here we go. All right, so first, the market has disappointed both bulls and bears. And the reason the market has disappointed both bulls and bears, in the opinion of BC Alpha, is because the market's kind of trading sideways. Like, we're not making new lows, so the bulls are disappointed, and we're not rallying anymore. So the bears are disappointed. We're not rallying anymore, so the bulls are disappointed. Yeah, the market has disappointed both groups. And the S&P 500 has been in a trading range since basically May of 2022. Now that's actually kind of remarkable to think that the S&P 500 has essentially been in a trading range since May of 2022. Let's go ahead and zoom out and look at May of 2022 on the screen here. This is Webull, and if we go to May of 2022, that is kind of eerie. So if you go ahead and jump over here and just draw a couple trend lines over here, let's just get a parallel trend line over here. Okay, we'll just grab this over here. So we go over to May. Here's essentially your top in May. And we'll just draw something that's mostly flat. I should have just grabbed the horizontal line, but whatever. And let's do it again over here. We go to roughly about our bottom in June. Oh yeah, I mean, we're well off of that, right? But I think this is roughly what they're trying to suggest, that this is the trading range that we're in. Very well, okay. What warnings do they have for us? We believe that many investors suffer from recency bias, and they're using 2008 to 2021 as a guide for their equity outlook. The bulls assume that any considerable drawdown would be followed by a large rally, as this is exactly what's happened since 2009. This is basically the buy the dip mentality that has worked extremely well since 2009. Bears, however, presume that poor fundamentals should produce a crash in share prices just like they did during the Great Recession. However, this report suggests that the market's trajectory this time will likely be different. Instead of a one-off collapse in share prices like in 2008, the S&P 500 will probably be in an extended bear market for the first time in 20 years. In fact, the S&P 500's pattern and trajectory have so far closely resembled the behavior of equities in 2000 and early 2001. First, the U.S. bull market peak of 2000 occurred after a decade-long exponential rally in technology, media, and telecom stocks, TMT. The same is true for the 2021 stock apex. Here you go. Here is that chart on the right side. You can see this drastic peak in TMT market value as a percentage of sort of the total market value, the MSCI total equity market value, basically the entire market. And then on the right side, you see that similarity. Interestingly, at the zenith of the bubble in 2000, TMT stocks accounted for about 40% of total market cap. The same was true last year. Okay, over here, historically, massive retail investor buying occurs prior to major market tops that are then followed by large bear markets. And the latest retail frenzy occurred in 2019 and 2020. This is very similar to what happened in the 2000s recession and then the subsequent 2000s crash. And they talk about this decoupling between new and old economy stocks temporarily during the initial 2000 to 2002 bear market. As it became clear that the US economy was in a major downturn, basically everything ended up rotating down. And they believe that today we see a lot of those similarities. In other words, non-TMT, technology, media, telecom stocks, and TMT stocks first decoupling, and then basically everything crashing. So let me make that clear in English. They're basically saying in the dot-com crash, first you saw TMT stocks fall, and then everything fell. And they think that's the same thing that's actually happening this time. Is first, you've seen a crash in a lot of SaaS companies and tech companies, and the next leg down is basically the S&P 500. Because the same thing that happened in the dot-com crash is going to happen now. That the SPY is preparing for a massive leg lower. And this is a very large warning. They make another correlation and say that there was a correlation between stocks and bonds. And basically, usually what you find is that in early January until October 2000, the S&P 500 exhibited a negative relationship with 10-year treasury yields. In other words, stocks up, yields down. And that negative correlation still exists today, but is weaker in 2000 than it is today. And that's probably because we have a substantial set of inflation today. However, what ended up happening was in the first phase of the market, you had a negative correlation. Let me just say this in English to simplify this, okay? So basically, the first phase of the crash in the dot-com era, yields up, stocks down. In the second phase, you actually had yields up, stocks up. And that was seen, or yields down, stocks down. So you had a correlation. Positive correlation means they're going in the same direction. Yields up, stocks up. Yields down, stocks down. That's positive, right? Negative is the opposite. And what they're saying is, at first, we had a negative correlation, and then we went to a positive correlation as the crash worsened. Well, guess what's happening today, folks? We were negatively correlated. Yields up, stocks plummeted. Now, we're turning positive. Yields up, stocks up. That is actually what they're saying, a massive red flag, and potentially a sign of a massive crash to come. They also talk about how profits often lead employment. They talk about this idea of basically employment being a lagging indicator. Look, we've known that employment was a lagging indicator forever. I've regularly talked about it even as early as January of 2022. And it was actually one of my reasons for selling that the conditions of a wage price spiral existed in January of 2022. They don't exist today. That's good. But it takes a while for all of that information to show up in data. Anyway, so that's how they see similarities. So they see massive similarities in the correlation of bonds, in the peak of TMT, and in employment. They see very, very large similarities to 2001. And they think we shouldn't be focused on a 2008 style crash. We should actually be looking at an S&P 500 bear market, just like in the 2001 crash. So big warning. Now, they do give us some differences. They say that even though there are massive similarities to 2001, obviously today, the genie of inflation is out of the bottle. And it might be very, very difficult to put the genie of inflation back in the bottle. And so they make some arguments here that we've had this massive rise in productivity during the dot-com era, but today we actually have a massive plummet in productivity. Now, some of that could be explained away by the changes of the pandemic leading to sort of this misallocation of resources and a lack of productivity. However, the employment cost index today has basically looked much more wage price spirally than what we had in the dot-com era. Now, let me just explain. The left side of this chart is 2001, the right side is today. I wrote the words higher triangle. Let me explain that in English. Well, first, that means higher delta. And in English, that means stuff is going much faster today than it did back in '01. In other words, stuff getting worse today faster than it did back then. We are accelerating faster today than it was back then, right? Higher delta, higher rate of change, the derivative is higher, whatever. Same thing for labor costs. Although it does look like the employment cost index has peaked. Now we're waiting for labor costs to peak, and the leading indicators are that they are. But these are actually differences that don't make today more bullish. They actually say what this report is trying to say is, look, the similarities are bad news for the S&P 500. The stuff that's actually different today is just more bad news for the S&P 500. Okay? So here's the bottom line. The cause of the bear market of 2000 to 2002 was a large drop in corporate profits. The same will probably be true in coming months. So when we talk about a hard or soft landing, our bias is that the economic recession in the US will likely be a mild one. However, the market will experience a large drop. Look at the confidence they have in this. I don't know if they're just like a frustrated bear, but they're really confident that even a small decline in GDP will lead to a massive compression in the S&P 500. During the 2001 recession, real GDP barely contracted, and household spending was actually positive. Interestingly, the measure of real private demand then was almost as weak as it is today. Even though you barely had contraction, you ended up seeing a massive collapse in prices because earnings per share were down about 60%. And so they say, in a nutshell, the S&P 500 dropped 50% in 2000 to 2001, even though nominal GDP never contracted. That basically means the recession was so shallow it took even like 1 or 2% inflation to make it negative, right? The latter will likely suffer considerably more than the former. And so what does that mean? Corporate profits are likely going to substantially suffer, and we're going to see a massive margin squeeze at S&P 500 companies. In other words, companies are going to take it in the margin. And the problem here is that if consumers accept higher prices so that companies can protect their margins, well, then inflation goes up and stocks go down. If companies push back against higher prices so inflation goes down, then stocks go down because earnings go down. And so even though they think bond yields are going to roll over and bond yields will come down, which will be good for the real estate market, they think that S&P 500 companies' operating EPS will contract by 21% from a year ago, and the S&P 500 risks a 50% decline. And so this equity bear market will likely be drawn out, much like the 2000 to 2002 period. And in short, despite the healthy balance of consumer balance sheets and a robust banking system, you are going to see a profit margin squeeze that will destroy S&P 500 companies by about 50%, and we're facing a major sell-off ahead of us in global stocks and another spike in trade-weighted US dollar. Basically, the emerging market outperformance still has another leg down. That's basically what they're saying. So, what says Kevin? Kevin says, this is exactly why I think the S&P 500 is a bad investment. Hashtag not personalized financial advice. It's also exactly why I think pricing power, PP stocks, are a very good investment right now. I think that pricing power stocks, companies that actually have the ability to maintain the strongest margins, and even in the face of price cuts, can expand revenue and continue to show EPS growth. I believe these stocks will perform the best. This is why I think personally investing in the S&P 500 is a bad idea right now. And I think focusing on pricing power stocks is the best idea because they've sold off the most and, in my opinion, have the most resilience in the face of this basically margin crush, the taking it in the margin that we're expecting here. This piece, in my opinion, is basically, and this just came out a couple days ago here, is really just a selling piece for the idea that get out of the S&P 500, find yourself some pricing power stocks. And like, I think maybe they're being a little bit more bearish than they need to be because I personally still think we're in a Nike swoosh style recovery. But so I'm not as bearish as these folks. But you know, if we're going to look at the S&P 500, which is heavily weighted to, yes, some technology, but also substantially staples, yeah, I think staples are going to take it in the margin. Hardcore. Retail, staples, restaurants, hotels, they're all going to take it in the margin. So yeah, I'd be very, very concerned for that, and I completely agree. This is the kind of stuff we also talk about in the course member live streams when we do our fundamental analyses. We look for large PPs. Like, we want to find large pricing power stocks. That's very, very important. My take. See what you think. Leave a comment down below.